Hello, everyone. I'm the stock market jobber, and we are going to talk about the top 5 things that we should look at. But today was such a crazy day, there should be more than 5, so make sure you check back because we talk about the market every day here. This is not a technical analysis class where we show our winners from a year ago. My goal is to help people like yourself learn how trading really works. So, anyway, it's pretty obvious the main thing to talk about is Credit Suisse. I always say Credit Suisse. My brother worked there for a long time and he's like, oh, Credit Suisse. But whatever. You know, it sounds like a cheese, like Swiss cheese. But anyway, let's take a look. So, this is Credit Suisse. Credit Suisse, right? Ooh, it's making me think like I should have ham and Swiss for dinner. But anyway, so this is Credit Suisse, and this is our 1 year chart, and we can see some interesting things going on here. So this is today, where this complete panic set in, and there's a chance that everyone, well, not everyone, but some people threw the baby out with the bathwater. There's a chance that people oversold it, and it might be a good time to buy it. I really don't think that the Swiss government would let this bank go out of business. It's just too much of their culture, too much of their image, and it would have real detrimental effects on their economy if they did. If the price gets low enough, then, a lot of different people will be able to afford it. I don't know about people, but institutions. So, anyway, let's look at a couple things here. Now, the first thing I see is this huge volume, right? This is the average volume is like way down here. And today we had this massive volume. Now, this could be a potentially bullish signal. And you're probably saying like, why is huge volume potentially a bullish signal? Well, the answer is it could be a capitulation. Okay. Now, a capitulation is when there's a lot of sellers around and they're just waiting for it to get a higher price. They're waiting for it to come back a little. They don't want to sell it at, whatever, 250. They want to wait till it gets to 260. And they keep waiting for a better and better and better price. That never materializes and it never happens. And finally, these sellers just get disgusted and they say, you know what? I hate this stock. I don't care anymore. I want to get out of it. A common expression on Wall Street in the institutional community is just make it go away. So everyone kind of throws in the towel. Well, I don't know about I don't mean everyone, I mean the sellers. So everyone kind of just throws in the towel, right? Now, that's why we have so much volume trading. Think about it like this. If you're some big shot hedge fund person and you got 10 million shares to sell, you might sell 1 million, wait for it to go higher. You might sell another million, wait for it to go higher, but it doesn't. Maybe you sell more down here. Finally, you're like, you know what? I don't care about this anymore. I hate this stock. I want it to go away. You tell your broker to sell for any price. And as a result, you get this big capitulation. You get this massive volume. And you can see we're also extremely oversold. Oversold means that we're trading at a excess or we've exceeded the threshold on the downside of what is this particular stock's normal trading range. So these oversold conditions are going to bring buyers into the market because they're going to be thinking this thing is so oversold it's going to reverse. And I'm not saying these are like long-term traders. They might be people that just buy it today and sell it tomorrow. Now with this volume, when you get this capitulation volume, what happens is all the sellers just get kind of washed out. So if tomorrow there are some investment managers or people that think like, you know what, I went through the news. It's not as bad as everyone seems. I don't know why anyone's panicking. There's a good chance that the Swiss government throws them a lifeline. I'm going to get back in and I'm going to start buying some. Well, here's the problem, right? With this big volume, the sellers have all been washed out. Like the sellers are done. So when the buyers come into the market, there's no sellers around. And they have to be willing to pay much higher prices to entice sellers to come in off of the sidelines. So that could be, or that could be the catalyst for a big move higher. Now, listen, I'm not saying like where's Credit Suisse going to be in a year. I'm just talking about trading. All right. So stock market job are we're mostly about trading. So we have a short-term time horizon, maybe a few days, weeks, or whatever. But regardless, I just want you to understand the supply and demand dynamics that are going on here. If all the sellers get kind of washed out, well, when the buyers come around, it's like there's no one to buy from. So they have to be willing to pay a premium. Now, before we go on to the next slide, we can see something that occurs a lot in bear markets. We got this buyer's remorse turning support into resistance. So support is where the buyers come out of the woodwork, the downtrend stops. But eventually, if we go lower, like here, well, a lot of the people that were buyers, they regret buying. They tell themselves, you know what? I made a mistake. Now that the price is lower, I want to get out, but I'm only going to do so if I can get out at the same price I bought it at. I don't want to lose any money. And we can see this. It's like a staircase. Markets don't go in straight lines. They go in like a succession of trading ranges. And it's like a staircase. You can see here, it's like a staircase, right? And when markets are going down, buyer's remorse causes support to convert into resistance. We got the buyers who bought it, they regret buying. When the price goes lower and they go to sell, get out of break even. Same thing happened here. Support becomes resistance. Support becomes resistance. Now, on the way back up, I would imagine that this level here, which is $3, is going to be resistance. But, I mean, in terms of percentage, that's a big move before we get there. And again, I just want to emphasize, because I'm not giving a recommendation, I'm just trying to teach how the markets usually work. And sometimes, usually, doesn't happen. All right, anyway, let's go to our next slide here. So this is just this Credit Suisse, Credit Suisse, just year to date. I'll have a Credit Suisse and ham on rye. Sorry about that. I couldn't resist everyone. So this just gives a bigger or a more detailed picture of the massive volume that traded today. All right. Now here's the level I talked about, 290. All right. So this is just year to date. Now what I want to do is I'm going to take a look at just today's chart. So today is March 15th, 2023, and this is just today's chart. So it shows you that this is where we opened. This was the high. We closed near the high. So maybe the word is getting around, or maybe not necessarily the word, but the analysis is getting around that, you know what, this is not Credit Suisse is not done. The government's going to throw them a lifeline. This thing's going to come back and maybe one day be worth a lot more than it is now. Now, again, this is not a trading recommendation or investment recommendation. I'm just saying it's something for you to think about. Stock Market Jobber wants you to learn how to come up with your own ideas. Right? I've come up with a lot of good ideas, but I've also come up with some ideas that weren't so good. What I want to do is teach you how to come up with ideas. All right, let's go to see the next thing that was important for today. All right, so here is the banking. This is an ETF that tracks the banking sector. Okay, ETFs they're basically baskets of stocks. They're all kind of merged together, and this ETF tracks bank stocks. So the only thing in this ETF are bank stocks. It's a basket of bank stocks. Now look at this, right? Back in 2020, there was resistance around the $35 level. Okay, pretty clear to see. Where did our sell-off stop or pause? I mean, maybe it reverses, but at the very least it stopped right around the same level, right around 35. And this happens because of seller's remorse. There are people who sold it back there, right? People who sold it back. Sorry, I'm just trying to use my pen here. There are people that sold it back here who, when the market goes up, they regret selling. Now, this is just the traditional reason. I would imagine there's more to it than that. There's probably a lot of these algorithmic trading programs are, recognized when they get to a former high or former low. But anyway, ooh, look at that. That's a spelling error. Let me get rid of that so you don't see it. Look, I'm a better trader than I am a speller. All right, well, listen, man, this isn't a spelling class. It's like learn how to make money class. But anyway, where did we find support? At the same level that was resistance. We have these remorseful sellers telling themselves, if we get back to the same level that I sold it at, I'm going to buy my shares back because I made a mistake. So this is the banking ETF. When things start to turn around, you may want to take a look at this. This is just a closer picture of, or a more detailed picture of the same thing, the same ETF. We could see, look how close we got here. Just there's really no way you can explain this, how something can have the same valuation at such different periods of time, unless you understand how charting works and you understand that if it's done correctly, it's just a graphical illustration of human psychology, right? So the reason why this is support is because it was resistance. The reason why resistance can turn into support is because we have remorseful sellers who regret selling when the price moves higher. They tell themselves if it gets back to the price they sold at, they're going to buy their shares back because then they can kind of mentally erase their mistake. And if there's enough, it turns into support like happened here. And you can see this on a lot of different charts. Okay, let's go see what the next thing is going on today. Here's oil. Oil made a big breakdown today, like real big. And of course, everyone's so obsessed with the banking news, the quote unquote pundits aren't really looking at this. I think this is a sign of an economic slowdown. This is not just trading. This is not just like profit taking. Like you could argue this was profit taking, right? We had a move here, profit taking. This, I think, is economic slowdown territory. And this could be telling us that, yes, we are going to this recession that everyone has been talking about for so long. With the way interest rates are going up, we got this going down here. We'll see. But I don't think this bodes well for the economy. This is just not, in my opinion, normal trading. There's something else going on here. So make sure you check back. Our marketing people are like, oh, you got to tell them to check back, check back, check back. Well, you should check back. So, because you're going to learn a lot. All right, what is the next thing I saw? All right, treasury bonds. The bond market is going absolutely nuts. Now, this is the inverse chart of the 10-year yield. Bond traders don't really look at charts of the prices, they look at the yields. And yields and prices are inverse. So if you can imagine, if we turn this upside down, the yield here was at like whatever 4.5. Now the yield is 3.5. So notice how the numbers are going in the wrong way. That's because this is an inverse chart. And I just wanted to show you what the chart of the bond would look like. Now, support, resistance. Why does support become resistance? Buyer's remorse. Investors bought their bonds here. When the price went lower, a lot of them regretted doing so. You see, you can see these principles in pretty much any chart of any financial security or any financial instrument. And we have people who bought here who regret doing so. This turns into support. Resistance. Now, check this out. We're extremely oversold. We've really ripped higher. We're at this resistance level for the bond. There's a real good chance that this reverses. And guess what? When interest rates start going higher again, the market is going to look at that as a negative thing. So that could put pressure on equities. All right, I think I got one more thing to look at here, everybody. Yes, if you're in the stock market, you should always kind of keep an eye on Apple, regardless of what sector you're trading, because Apple by market cap is the biggest, far and away the biggest stock there is. And this level here is 155. We see where there was resistance here, there was resistance here, resistance here. The market's moving higher. There's just not enough supply to satisfy all the demand. When we get to a resistance level, that's where the buyers come out of the woodwork. So, in my opinion, there's a real slim chance of the stock market going higher with Apple being below 155. If it gets above it, I'll change my opinion, but considering what's going on with the interest rates and the bond market, my guess is we head lower. Anyway, make sure you check back, everybody. Thanks for checking out stockmarketjobber.com, and I will talk to you soon.